Please welcome the panel, and where is he? Michael Bucella, come to the stage.
Excellent. Great to be back at CFC. A slightly less mysterious panel than the dungeon, although one that is, I would say, somewhat veiled in some mystery, which is market making liquidity in any market generally, but particularly within cryptocurrencies. And so this is a lesser known part of the market where billions of dollars are made on an annual basis. And 3 of the largest market making desks in the space are represented here. I'll start with introductions. You can take it away, Philippe, and then we'll move down the line here.
Thank you, my Miami friend. Good to see you. I'm Philippe Bekhazi. I'm the CEO and founder of XBTO and Stablehouse. For the purpose of this panel, we're going to be talking about institutional liquidity, and so it'll be more on the XBTO side. XBTO was started in 2015. We were early on trying to provide institutional grade liquidity to centralized exchange. And obviously, since then, we've evolved into, well, decentralized finance, structured products, then obviously things like NFTs, which we'll get to.
Hi, I'm Aurora Schwarz from Wintermute, Director of Strategic Partnerships. We partner with traditional institutions, token issuers, OTC counterparties. We provide services across the board from market making. We do OTC derivatives trading. We do treasury management. We also do investments into a lot of blockchain projects and DeFi ecosystem.
Thanks. So I'm Jakob Palmstierna. I'm a partner and the CEO of GSR. We are also a programmatic trader in the crypto space, founded back in 2013. And we trade on-chain, off-chain, across both spot and non-linear assets.
Great. So clearly, organizations doing a handful of things, all centered around market liquidity, which provides information, which provides advantage and opportunity. I think for purposes of the crowd, and I'm sure everyone here, well, the 4 of us come from traditional backgrounds, but maybe some folks in the audience don't. So I'll throw this out to the crowd. Let's just start with market making. Why does it exist? Who does it matter to outside of the organizations that are, yourselves and the bottom line of your P&L? Who does it matter to within crypto? And then really, what is it at its most basic level? And I'll leave that open to any 3 of you to pick up.
I'll kick off. I think it's really about providing liquidity to the end user. And so particularly when you've got times of stress, you need that bid and offer, which is crucial to any healthy market. And if you look at more mature markets, equities, fixed income, etc., really having good liquidity on both sides is crucial to having a long-term healthy and viable market. And certainly over the years, there's more players now coming to crypto providing liquidity services, but it's crucial for this ecosystem to really evolve is actually having liquidity.
Sure. And who are the participants? So as a hedge fund manager, we appreciate your services very much. It's allowed the growth of the asset management industry. It allowed you to trade things down the risk stack that are, potentially much less liquid, that your organizations have ended up providing liquidity to over time and allowed everything to scale. So there's funds like us. Who are the other main players in the space that you all are providing liquidity for?
That's a great question. I think if you look at, we obviously partner with a lot of projects, so token issuers. We're providing liquidity on the exchanges. We're also partnering, obviously, with traditional institutions, but also via OTC, via bilateral relationship. If you're on board with Wintermute, as an example, you're able to trade spot and derivative products. And so what that means is you get best execution and very fast pricing that you perhaps wouldn't get in a normal environment.
Mm. And so I guess we'll start here. So you guys have been around for a long time, XBTO. You've been in the markets for a long time. What has given you, so obviously let's kind of go through what's changed. We're focusing more on the last 12 months, but obviously you can go back a bit further. And what you're most excited about over the next kind of 6 and 12 months. We'll start with you, we can work down. And also just why did this opportunity exist? Why didn't everyone else dive in when the opportunity was ripe? Was it a higher risk appetite, or was it something you all saw that the rest of the world didn't? Regulatory ambiguity, and so
right. Well, I started in Bitcoin very early on, 2011. In 2011, to get access to Bitcoin was very difficult, right? As Meltem earlier said, you had to go through kind of shady, websites that were very far away. You had to send money and close your eyes and hope that the money would arrive. The concept of security was completely disregarded.
The dungeon didn't exist yet.
The dungeon did not exist. It was, very fragmented, and there was no real confidence. I mean, I had zero confidence, but at the time, for me, it was a hobby. It was something like I was interested in technology, right? As time went on, I realized that more and more exchanges were propping up, right? And there was more and more interest, retail at the time. And I thought, with my background, I thought, well, it would be interesting to sort of bring my experience and experience of my team, which was very little at the time, because in 2015, I mean, the market cap of all of crypto was a couple $2 billion, not much. So not much to really build a business on, but it was kind of a leap of faith. And in 2015, we approached what we thought was the best entry to the market, is approached an exchange that had the distribution. And we said, we'll make a better market for you because your bid ask really sucks, right? It was like this. Yeah, and how could you create and instill confidence to your customers if you had a bid ask this wide with trades that would happen every, 10 minutes? I mean, there was something that needed to be done there. And so we thought that, high frequency would eventually come to the market. And we just built systematic algorithmic systems to make markets this first exchange. And then by the end of the year, we were doing on 5 exchanges. We were able to pay salaries. And obviously from there, it just mushroomed into fanning out into different verticals, right? It was centralized exchange, and token issuers needed liquidity. So we approached them and said, we can make liquidity for you. And then you had more and more customers, right? Now the institutions started coming in. Now you're marketing to a different, you're targeting a different kind of client that had different needs. They wanted hedging, they wanted futures, they wanted structured product, they wanted options, but they wanted security. They were very much more structured in the way they were thinking about who do we partner with to get our liquidity? And a lot of them are regulated, so that also created certain issues, right? Because regulation always is behind technology. So, now we've got AMMs, automated market makers. We've really kind of dove down that rabbit hole of crypto. We're doing so many different things. We'll see what happens in the next 10 years. We're looking out 10 years. But to be honest, it's getting more and more difficult to think about what's coming out in 10 years. I'm so surprised at the speed of evolution, and just NFTs, we're a little bit behind on NFTs, to be honest. And there's so much going on in there, and how do you make a market in something that's so fragmented? Anyways, so yeah, that's for XBTO, and we're always at the forefront, but we're careful players. We tiptoe.
And Aurora, for you, I know we were talking about altcoin derivatives, which I would be thrilled to see from a hedge fund standpoint, but where you kind of see the market moving? Yeah,
I mean, if you look at sort of 2020, we were covering around sort of 35 tokens. We now cover over 200 tokens. So our specialty is really on that sort of altcoin space, on the longer tail, more esoteric tokens. We really cover quite a large gamut of projects, and that's why we have so much inventory. We are able to cover such a huge range of altcoins. But with coming with that, we've seen obviously over the last sort of 12 months, a lot more sophistication in counterparties in general, and they're requiring different needs. For instance, miners might want to sort of hedge some risk or, offload. You've got sort of hedge funds or traders that, in the past, you could pretty much just go long. You weren't able to play the downside. Now with derivatives, you're able to play the downside, you're able to hedge. And so that wasn't available, say 12 months ago. And that's really where a lot of the growth is. We sort of made the conscious decision to be, more institutionalization, from sort of late 2020. I mean, you've seen some of the corporates were adding, back then, Bitcoin to their balance sheet, MicroStrategy, Tesla, Square. So that there was a significant change, I think, in that sort of 2020 phase. And then fast forward, last year, obviously things just blew out, obviously with, what was happening in the market. And and consequently now it's becoming a lot more mature. And then at that maturity comes a more diversified product range, particularly in the derivatives segment and structured products, as you've mentioned.
Jakob?
Yeah, I think you know, the digital asset markets, they aren't inherently liquid. They are very active. They look and feel much more like a, you know, S&P futures than they do a very liquid contract like, you know, interest rate, for example. But liquidity inherently very, very important for digital assets. And I'll get to that, but that's why we exist. So why is it more important than any other type of asset class? The cryptocurrencies or digital assets are sort of have a lot more properties than, you know, say a stock. You know, one is that people are trading and speculating it, and it sort of access the capital markets. But much more than that, you know, the token is the utility to make the underlying disruptive technology work. So you have this, you know, validation of the blockchain itself, which is traded on, and it needs liquidity to have that. You have the governance. So all the people that interact, whether it's on the protocol layer, on the scaling layers, they need to have a buyer and a seller of last resorts for this whole thing to work. So getting in there very early, like all of us did, is sort of to consolidate the fragmented liquidity across all the digital assets to ensure that there is a buyer and seller of last resort, to ensure that these innovators who's build their technology based on a digital assets, which is really powering it, has that underlying liquidity. Same way as, you know, if you buy a Tesla, it doesn't matter if you have sort of, you know, some speculators shorting the Tesla stock. Your car is going to look the same. That's not the case in crypto. So you need to have real partnership. If you've been backed by hundreds of millions of dollars for A16Z or, you know, Sequoia, and you worked for 3-4 years, and now you're launching something that isn't mature and it's getting liquidity day one, you want to make sure that doesn't get manipulated and you're out of the market immediately. So that's where we play a big role. And similarly, over this year, if we talk about that, you know, the summer before last, we have sort of the craze in on-chain, so decentralized finance with sort of yields sometimes in the thousands. That was pretty crazy, but the promise of decentralized finance is the disintermediation of some, not all, of what's happening in capital markets today by utilizing a smart contract as the central function instead of, you know, a bank or whatever you have. There is a huge amount of talent density in that space. There's a huge amount of capital going into that space. It doesn't trade that much today. It's about 5% of the global liquidity. GSR, we trade about 20% of our liquidity in decentralized on-chain. But what is very big, and I think we saw a slide on that before, is the total value locked in on-chain, which is around $200 billion today. And we have sort of integrated with all those protocols to make sure that we cover most of it. And that means that we can help our clients to secure the blockchain, help them run validators on chain and provide liquidity versus these are on, you know, bonding curve like pools, Sushi and Uniswap, or it's not central limit order books that they have on DYDX, for example.
I think it might be helpful to help people understand the relationships between, so on the hedge fund side, we obviously trade in spot, we trade in derivatives, we'd love that market to expand further. On the VC side, we invest in companies, right? Sometimes there's token elements, sometimes there's token contracts, their equity with conversions to tokens, and obviously those projects will look for market makers in time to develop liquidity in their underlier and then ultimately assist in, saying, facilitating a listing on an exchange. So maybe explain a bit more about the relationships you have with projects in this space, how that evolves, and the other side of that being the relationship with folks like exchanges and how that all kind of comes together within this broader world of liquidity provision.
Yeah. Well, it's all about the network, right? Bitcoin is very, very successful because it's got the deepest network. It's also got the biggest security. And the value of the network really makes what, you know, a market maker who has the biggest network of exchanges and venues will have more value than a market maker that has less. So to a token issuer who is basically trying to figure out, okay, I'm creating a token of value, could be a utility token, could be a security token. These days, security tokens not so much, because liquidity for anything that's security is kind of diminished because it requires a ton of regulatory work, and it's very fragmented, and you need to find exchanges, and there's a lot of transparency. So a lot of people are trying to basically use utility tokens to basically back up their balance sheet so that they can use it mostly for marketing. And we've seen it with like BNB tokens, crypto.com. A lot of these companies are spending a ton of money. They're doing it through this very, very liquid token that is effectively backed by some market makers that decided that they were going to take some risk. You have to inventory risk at some level. Someone's taking risk somewhere. It doesn't disappear into the ether. Now, obviously, a successful market maker is one that can dissipate risk the most effectively through the network, right? If you can manage to not warehouse risk longer than your competitor, you're usually going to do better. Because otherwise, you're at the mercy of the market. Yeah, of course, if the market goes up and up and up only, as we've seen, you're going to make more money than the next guy, but you also have taken more risk. So it really is about creating deep ties into the community. That's the value, to me at least, of what a good market maker would be.
Anyone else?
I think for us, we've always been heavily involved in the DeFi ecosystem. As an example, we're integrated into 6 protocols. As a result, we're able to really sort of help a lot of the projects early on, not only just advisory, we're obviously able to help with really partnering with the projects quite deeply. We help validate nodes, we get our hands dirty really in terms of how we support the projects. We also can help support, their treasury and an ongoing sort of, growth of the projects. I guess for us, when we do partner with projects, we're always looking for longer term partnerships and a view with how we can help sort of co-build and really partner with the different projects. And I think that's been a function of, early on in the business, we did integrate with a lot of exchanges. So we have very close relationships with all the top exchanges. Heavily connected to a lot of the decentralized exchanges as well. And I think it's just that sort of, for us, the core has always been technology. And so having that sort of foundation from the very beginning has allowed us to move very quickly and to be able to partner with quite a large range of projects. And a lot of it's just been through word of mouth and referral now, because projects come to us, they've been really happy with us, and then, it's a knock-on effect.
I agree with what's been said. I guess one of the sort of differences, again, from sort of traditional finance, you have capital markets play, you have designated market makers. They are not necessarily viewed as the nicest kids on the block. The name shark tends to be used for these type of firms. Generally, their job is to extract value out of the market at any single point in time that they can. In digital assets, it's very, very different. I think all the firms here, partners will, hundreds of different projects, not sure exactly what the details are, but bring in long-term relationships. And it starts with having not about somebody to extract initial value out of your market, but align yourself for the long term. So creating an alignment model. A lot of us do this between, we see very early deal flow by virtue of being good ecosystem players, and people want us to be aligned on the cap table if we work with them for many years, and having that continuous structure that we talked about here, that initial liquidity, context with the exchanges. Of course, we are important for the exchange from the exchanges point of view. There are many people trading BTC and ETH, but where the real innovation is happening is not in BTC today. It's in all these disruptive technologies where $30 billion have been invested from the ground, from the VCs, and those are the assets that they want to list, and we are the ones providing liquidity for it. So it certainly helps, and it takes away a lot of this market stress, which might not necessarily be the expertise of the engineers that are building these projects, but it's our expertise. And if we have an aligned and good partnership with them. We look after the markets, and they look after the technology and can focus on building their community.
Great, and I want to make sure we leave some time for questions, so maybe I have one or two before we open it up. But so just walking down the liquidity stack. So from the hedge fund perspective, if we want to de-risk our book, by 20 or 30%, you could sell $200 to $300 million of Bitcoin and ETH like water. Trade's very liquid. Down the stack, it's gotten significantly better over the last 12 months. But there's still some kind of kinks to work out. I think on the derivative side, that's grown substantially, but still not as deep as I think everyone would like it. I think when we traded, I think it was the first variant swap in the industry. It was this big headline. It was a tiny, it was a tiny trade, but obviously it was the first of its kind in our space. And I think that we want to continue to push that.
Might still be the only one of its
I think
kind.
it might be the only variant swap.
It wasn't a blockbuster,
yeah,
but it was cool to do.
Yeah, it was fun to do. But then thinking about even more innovative sectors, NFTs were brought up. Just thinking about kind of which, in your minds, are the most innovative sectors of the liquidity portion of the market that you guys are focused on or looking at or thinking about today, that you think either one, is obviously towards scaling a massive business, whether it be, options and altcoin derivatives, or, NFT market making, algorithmic NFT market making, right? Trading Bored Apes.
Yeah. Well, AMMs are interesting for sure, but to me, one of the things that I think is really necessary right now is some kind of decentralized, zero knowledge proof kind of prime broker that sort of gives you more visibility on the risk of your counterparty, because variant swaps are cool instruments, but the problem behind a variant swap is not necessarily that the product's broken, it's that the operational stack and the capital efficiency behind it is such a mess. You've got to have a calculation agent, you've got to agree on the calculation, you've got to figure out your margining, who pays who in what currency. It's like, you've got ISDA that does that, but who wants to, spend 3 hours on a trade, right? So you want to be able to.
Head of operations loves it.
Yeah, I'm sure he does. And is it still live, by the way? What was the maturity of that variant swap?
It's done. It's
Okay.
Yeah.
Anyways, but it's for me
It was
that
years
is
ago.
like
It
super
wasn't
cool.
a 3 year. It was
That would be insane. But they are going to come. They're going to come. But it's like Deribit. So we invest in Deribit very early on. We believed options would come to crypto, and it was crickets for a very long time. We were the only market maker there. We were strategic to them, and it took a long time for people to come and for the ecosystem to grow. And eventually you hit that hockey stick and it works. But, everything from margining, settlements is done at Deribit, which is cool. But it's kind of very centralized. I'd love to do an option with you and lay it off on Deribit and get a capital offset. Because for me, I don't want to have margining with you and margining with, all of the marketing desks, market making desks on the street. It becomes completely nuts on my balance sheet, and it's an operational nightmare. So for me, that'd be number one.
So you guys are incubating this now. Aurora.
Maybe.
I think to your point before, actually, nearly $30 billion last year of VC funding has gone to this space. So with the majority sort of going, the key sort of top line was NFTs, blockchain gaming, and DeFi. And so really on the DeFi side, that's where the real innovation is happening. If you look at Ethereum, Bitcoin is a dinosaur for DeFi now. It's old technology. It's not even relevant anymore in the DeFi space. And if you look at Ethereum, there's a real issue with scalability. It's a real problem and it's very hard to solve. And so what you'll see is a lot of these side chains coming up that will be alongside Ether. Because the problem with Ethereum, it can't do millions of transactions at $1 each, and it's not going to be able to. And the next big upgrade in a year's time is not solving the scalability issue. So really what you're going to see is a lot more side chains become more prevalent and gain traction, and they will help support projects. And if you look at the ones, for instance, gaming, that needs a lot of transactions but low fees, that's where there's a lot of opportunity as well in the space.
Yep.
Two big things for us. We have a few different things that we focus on. Obviously, DeFi was a big thing this year. I think we touched upon it, but options market for altcoins, like the opportunity to express a view in any dimension for any token should be aspirational, and we should develop those markets. Generally, I think we are uniquely positioned to do that in the seat that we are. So that I think is going to be huge. Today options markets are very small relative to what they are in other markets. There's no reason they shouldn't be. There's one of the most sort of powerful tools for any healthy asset. So super excited about that. Today you go on screen, you find 2, BTC and ETH. You should go out and find 200. That's fantastic. That'd be amazing. So that's coming. The other thing, which is a little bit of a stretch, is maybe the misnomer of market making, but market making on NFTs, by definition, it's not really market making. Take risk in different particularly sort of generative NFTs on our space, which is an interesting mathematical problem, honestly. So yeah.
Great, excellent. We've got probably time for one question quickly, maybe 2 if they're very fast, but let's open it up to the audience. Someone's got a question. We've got one here.
What are your thoughts on the evolution of DeFi 2.0 being the protocol on liquidity and the blah, 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 the new thing? Are you guys involved in that game, or it's like a stretch? Thank you.
I think in the next 2 years, how you see DeFi now, it's going to be very different in 2 years' time. The technology is moving extremely fast, but there's, I mentioned sort of the scalability issue with Ethereum, and I think there's going to be other potential projects that will try and solve that.
I like protocol on liquidity. I think it's interesting. We invested in Tokamak, which is one of the ones focusing on that. It makes a ton of sense. I've never been a huge fan of the bonding curve 1.0, so I'm very happy to see that the decentralized exchanges are maturing a little bit. And the reason I don't like it is because the price can only move if something trades, which is very, very weird for someone who comes from traditional market. But that's probably going to change. So, yeah. I just saw the clock going to 0, so I thought I'd be
good
quiet.
timing. Excellent timing.
Nice.
All right, great. Well, thank you to the panelists. Thank you to the audience for listening. Feel free to follow up with anybody here throughout the conference. Thank you.
Thank you for having us.
Thank you very much.
And thank you very much, Michael.